You all can speak. Come on. First ratio that we're talking about is liquidity ratio. Do you know any liquidity ratio?
Uh,
First liquidity ratio is our current ratio. Current ratio is current assets over current liabilities. Okay. It tells us that will my current assets be able to pay my current liabilities? At any point of time, your current assets is to current liabilities. Your current assets should be 2 times your current liability. First liquidity ratio, current ratio. Ideal current ratio is 2:1. Are you with me?
yes,
Yeah.
miss.
Do you know the other liquidity ratio?
Quick ratio.
Quick ratio. The other name for current ratio is what? Quick ratio. Can you give me the other name for quick ratio?
Acid test
Acid
ratio.
test.
Acid test ratio. What else? Quick ratio, liquid ratio, acid test ratio. Are you with me?
Yes, miss.
Okay, fine. Quick ratio, liquid ratio, acid test ratio. What is the formula for quick ratio, liquid ratio?
Liquid assets upon current liabilities.
It will be quick assets over current liability. When I say quick assets, how do I get the quick assets? Bakir, you can also answer. How do I get quick assets? It will be current assets minus your closing inventory. But when you minus the closing inventory, it should exclude your inventory of loose tools. Minus prepaid expenses. Are you with me?
Yes, miss.
Quick assets minus closing inventory minus prepaid expenses over current liabilities. What does this tell you? How quickly you can pay your quick assets. How quickly you can pay your current liabilities. The ideal ratio is 1:1. I'm sure you know this. Okay. Now I'm going to the new ratio, which is called the solvency ratio. What is it called?
Solvency ratio.
Solvency ratio. The first solvency ratio that I am discussing with you is the debt to equity ratio. Understand this very properly. Debt means what? Debt means loans. And equity means owner's funds. Are you with me? Debt means loans and equity means your owner's funds. So when I am talking about your debt to equity ratio, that means it tells me in my total capital. What does it tell me? In my total capital, how much is the borrowed funds and how much is the own funds. Debt to equity. When I say debt, the debt will come in the numerator. When I talk about equity, equity will come in the denominator. Debt to equity. So in your total capital, how much is your borrowed funds? Borrowed funds is called your debt. Equity. Owned funds is called what? Your equity. Are you with me?
Yes, miss.
Okay, the formula for this is debt over equity. So when I talk about debt, it will be your long-term debts. So long-term debts over equity or shareholders' funds. How do you get your long-term debts? Long-term means long-term, and debts means your borrowings. So how do you get your long-term debts? It will be your long-term borrowings plus your long-term provisions. With me?
Yes, miss.
And how do you get your equity? Equity, that means your shareholders' funds. It will be your share capital plus your reserves and surplus. Okay? If you have a low debt to equity, it means your loan is less and own funds is more. Okay? If you have a higher debt to equity, it means your debt is higher, your loan is more. Are you with me? So
Yes.
something which is less than 1, that means your debt is low. More than 1, it means your debt is more. Giving you time, go through it, digest it, learn it, write it. If you have any questions, tell me. Tells you that in your total capital, how much money is borrowed, how much money is owned. What is borrowed is debt. What is owned is share capital plus reserves and surplus. If you have a low debt to equity ratio, that means your loan is less. Higher debt to equity means loan is more. Your next ratio is your total assets to debt. It tells you to buy your total assets, how much loan you have taken. Okay? How much loan you have taken to get your total assets. I'm repeating again. Total assets to debt. It tells you that to buy your total assets, how much debt, how much loan you have taken. When I am talking about total assets means your non-current assets plus your current assets. Yes? When I am talking about debt, what is the formula for debt? Long-term borrowing plus long-term provisions. What is the formula for debts? It is long-term borrowing plus long-term provisions. What is the formula for total assets?
Non-current assets plus current.
Non-current assets plus current assets. Understand, this will include your inventory for loose tools. Okay? If you have a higher ratio, that means your total assets is more than your debts. That means the lenders have security because your assets are more, loan is very less. If you have a high ratio, when I'm saying you have a high ratio, that means your total assets are more, your debts are less, the loan is less. So your lenders have security. If you have a low ratio, that means your assets are less and your loan is more, then lenders have no or little security. When I'm talking about proprietary ratio, proprietor, do you know what is a proprietor?
Uh,
Proprietor
owner,
is the owner,
owner of the business.
owner of the business. So when we talk about proprietary ratio, that means in the total funds of the company, how much is the owner's funds? Okay. If proprietary ratio is 60%, that means in the total funds of the company, owner has put in 60%. If the proprietary ratio is 80%, that means in the total funds of the company, owner has put in 80%. Why do you want to know this proprietary ratio? To see whether the business is more dependent on the owner or it is dependent on loan. If it is more dependent on the owner, that means it has a good amount of security. The owner is confident about his own business. Are you with me?
Yes, miss.
So when I am talking about proprietary ratio, it means that in the total funds, the total company's funds, how much is the owner's funds? Owner's fund is also called shareholders' funds. It is also called proprietors' funds. It is also called equity. Okay. Owner's funds means the share capital plus the reserves and surplus. Owner's funds means the share capital plus the reserves and surplus. So when I talk about proprietary ratio, it means your proprietors funds. Proprietors funds is what? Proprietors funds is owners funds, shareholders funds, equity. Owners funds means what? Share capital plus your reserves and surplus. So the formula for proprietary ratio is shareholder funds divided by your total assets. When I talk about total assets, it means your non-current assets plus your current assets. Are you with me?
Yes.
Owners funds over total assets. Owners funds means the shareholders funds. Shareholders funds means share capital and reserves and surpluses. Okay. Now, when they ask you to calculate the proprietary ratio, they will never give you the owner's funds directly. You will have to calculate it. There are two ways to calculate this. First is called the liability side approach. What is it called? Liability side approach. Do you know about this or no? Ask you to calculate proprietary ratio. The numerator will be the shareholders' funds and denominator will be your total assets. Okay. Shareholders funds means what? It means your share capital plus your reserves and surpluses. So you need to calculate this. How will you calculate? There are two ways to calculate it. First is your liability side approach. Liability side approach, that means you start from the liability side. You have your liabilities on here and assets over here. Are you with me? In your liability, your first part that you have is what? Your share capital and reserves and surplus. When you add both of this, you will get what? Shareholders funds. What will you get? Shareholders funds, or I would say this is the proprietors funds, or I would say this is your equity. Your main target is to arrive at this figure. Okay.
Yeah.
The other side approach is the asset side approach. Asset side approach, and you have to arrive at this figure. Which figure you have to arrive at? This one, which I'm circling. You want the total of share capital and reserves and surpluses. So when you are at the asset side approach, you start from the asset side. Your assets are made up of your non-current assets plus your current assets. So I say my non-current assets plus the current assets is total assets. Yeah. From your total assets, when you will subtract your current liabilities, you are going to get what? This part. Say for example, your total liabilities is 200. Current liabilities is 10. So can you tell me how much will this be? 190. This is what? Share capital plus reserves and surplus plus the current liability will give you your total liabilities, correct?
Yes, miss.
Okay. So if I know my total liabilities is 200, current liabilities is 10, so how much will the shareholders funds be? 190. Let's do one more example. Say my total liabilities is 800. Current liabilities is 20. How much will my shareholders funds be?
780.
780. Very good. Let's do one more example. I say my non-current assets is 50, current assets is 50, current liabilities is 5. Can you give me my shareholders' funds?
With 105.
How?
Non-current plus current assets.
What is your total assets?
Total assets is 100.
Okay. What is your total liabilities?
5.
Your total assets is always equal to your total liabilities.
It's 100.
Total assets is always equal to your total liabilities.
Yeah.
So if your total assets is 100, your total liabilities will also be 100.
Yes.
Yes, miss.
From that, if you minus your current liabilities, how much is your shareholders' funds?
95.
95. One more example, come on. Non-current assets is 80, current assets is 10, current liabilities is 2. Can you give me your shareholders' funds?
$88.
First, tell me your total assets,
Total assets is 90.
total liabilities.
90.
So, shareholders' funds would be
88.
88. Zayden, are you there?
Yes, miss.
Okay, fine. So, can you give me the formula to arrive at the shareholders' funds from the asset side approach?
Asset. Uh,
Give. Will it be the non-current assets plus the current assets minus
yes, miss.
the current liabilities?
Yes, miss.
Yeah. Alternatively, I can say total assets minus current liabilities. Yeah.
Yes. Yes.
See, total assets minus the current liabilities.
Yes.
Alternatively, I can say total liabilities minus the current liabilities.
Yes.
Yeah. Zaidan, giving you
Yes,
time, go through this slide, write the asset side approach and liability side approach to find the shareholders' funds. What is the meaning of proprietary ratio? What is the formula for proprietary ratio? Memorize, then I take you to the next formula. Your next formula is your interest coverage ratio. Do you know what do you mean by interest coverage ratio?
interest coverage.
Okay.
Cover your interest.
Who will cover your interest? Okay, I will tell you. When I say interest coverage ratio, that means your profit can pay your interest how many times? How many times is your profit capable of paying your interest? Okay, understand this fact very clearly. Say, for example, your interest is 10 and your profit is 100. What does this mean? Which profit I'm talking about? I'm talking about the profit before interest, before tax. It means that with your current profit, you can pay your interest 10 times. So profit upon interest is this 10. So that means with your current profit, you can pay your interest 10 times. Okay. That means you are much capable of paying back your interest. You cannot pay interest just one time, you can pay interest 10 times. Say your profit is 1000.
Miss, 10 is the ideal number.
No, this is just a random example.
All right.
Okay, ideally your profits should be sufficient to pay your interest. Say your interest is 10, so your profit should be minimum 10. Then you can at least pay interest 1. But say your shareholders, your debenture holders, or the bank who gives you loan, will they be happy to see that your profit is only 10 and interest is 10? They would say if this person is earning 10, okay, the profit is 10, and they pay me interest 10. That means they have nothing to take home. They are taking home 0. Next year, they can earn more or they can earn less. There is no stability for the next year. So the debenture holders will not give loan to such a type of a company. Will they?
So,
But suppose you say your profit is 100 and interest is 10. That means your profit is capable of paying your interest 10 times. How do you get the formula? Profit before interest and tax divided by your interest on the long-term loans. Interest coverage ratio. How many times your profits can pay your interest? How many times your profits can pay your interest? Say your profit is 1000. How many times can you pay your interest?
10.
Profit divided by your interest, 10. You can pay 100 times. That means your profit is so much sufficient that you can pay 100 times interest without earning more. Okay? So interest coverage ratio tells you how many times profit can pay interest. Okay? Or how many times you can pay interest with your current profit. But which profit are you talking about? Profit before interest and tax. Which profit are you talking about? Profit before interest and tax. How do you get that profit? Sales minus cost of sales gives you gross profit. From this gross profit, you will subtract your other expenses. Your other expenses are what? Your administrative expenses, your selling and distribution expenses. You get this profit, which is called your profit before interest and tax. So when you are doing your interest coverage ratio, you are going to use which profit? Profit before interest and tax divided by your interest on long-term debts. With me?
Yes.
From your
Yes, miss.
PBIT, when you minus your finance cost contains your interest charges. So you get your profit before tax. When you minus your tax, you get the profit for the year. The more number of times you can cover your interest, more number of times you can cover your interest, the better. Okay? Who will use this interest coverage ratio? Your debenture holders, your banks, all those people who are giving you loan, they are interested to see your profits can cover your interest how many times. Write it, I'll wait. So we studied 4 solvency ratios now. What are the 4 solvency ratios? The first one, debt to equity ratio. It tells you that in your total funds, how much is your borrowed funds, how much is your own funds. Total debt upon total equity. Total debt means long-term borrowing plus long-term provisions. When I talk about equity, equity means what?
Own funds.
Huh?
Own funds.
Own funds. Own funds means what? Share capital plus reserves and surpluses. Second one was total assets to debt. It tells you that how much of your total assets is financed by your debt. To buy your total assets, how much debt you have taken. Formula for this is total
Yes, miss.
assets over your total debt. If you have a high ratio means lenders have security, your assets are more. If you have a low ratio means your assets are less, lenders do not have a lot of security. When I talk about total assets, your total assets are your non-current assets plus your current assets. Proprietary ratio. It tells you that in your total funds, owner's money is how much. Formula for this is owner's funds divided by your total assets. How do you get owner's funds? It is share capital plus reserves and surplus. This is the liability side approach. Asset side approach would be your total assets minus current liability. Are you with me?
Yes, miss.
Interest coverage ratio, the formula for this is profit before interest and tax over your interest on long-term debts. It tells you your profit can pay back interest how many times. How many times your profit can pay back your interest, and the profit that you're looking at is your profit before interest and tax. Are you with me?
Yes.
Then you have your
Yes, miss.
turnover ratios. First is your inventory turnover ratio. The formula for this is cost of sales over average inventory. Yeah. Average inventory means your opening inventory plus your closing inventory divided by 2. When you say cost of sales over average inventory, that means how many times your stock is getting replaced. How many times you replace your inventory. How many times your stock is getting converted to sales. If you reverse this formula, you get an answer in days. That means in how many days your inventory is getting converted into sales.
Yes.
Then there is trade receivable turnover ratio. Trade receivables over credit sales into 365. In how many days you collect money from your trade receivables? Yeah.
Yes, miss.
And if it is credit sales over trade receivables, so how many times you collect money from your trade receivables? Similarly, you have your trade payable turnover ratio. It is trade payables over credit purchases into 365. The answer that you would get will be in days. In how many days you pay your suppliers? Ideally, you would be asked this in days. If you want in times, you just reverse the formula. It would be credit purchases over trade payables. Answer will be in times. In a year, this many times you pay your trade payables. Please remember in times you do not need to multiply it with 365. We've already done this, right?
Yes.
Profitability ratios. There are 5 profitability ratios. Do you remember margin is on? Margin is on?
Gross profit.
Margin is on sales. Margin is on sales and markup is on costs. So when you talk about the gross profit ratio, it will be gross profit over revenue into 100. With me,
Yes, miss.
operating ratio, it would be your operating cost over revenue into 100. When I say operating cost, that means it will have your cost of sales plus your selling expenses plus your administration expenses. With me,
Yes, miss.
operating profit ratio, it is your profit before interest and tax over revenue into 100. Net profit ratio, the last profit that you get over revenue into 100. Return on capital employed or return on investment, it means the same thing. Formula for this is profit before interest and tax over capital employed into 100. How do you get your capital employed? It is shareholders funds plus your non-current liabilities. Are you with me?
Yes.
You know all the formulas?
Yes, miss.
We've done all the formulas. Now what am I doing is I'm trying to do a recall session where you will check how many formulas you know. I will write the name of the formula. You try to write the answers. Don't know, no? You all will answer this ratios as a test. There are these 16 ratios that you should know in this chapter. And finally, you will prepare a format of the income statement.